Hey, welcome back. In today's headline highlights, I have a lot of information to cover and go over, including some really newly released data from this morning that really paints an ominous picture of a housing bubble that looks like it's just starting to pop and has a long way to the downsides. Plus, at the end, I'll go over some updates with the economy and what must happen, really, according to the Fed, one way or the other, in order to get inflation under control. That's all coming up in today's episode, so let's get started. Hey, thanks for tuning in. I'm Rick Harrison with MVP Realty down here in Southwest Florida. And in today's headline highlights show, I'm going to be going over quite a bit of information and stories that have been recently coming out about the housing market and the economy and what the Fed really hopes to do in order to get inflation under control. Plus, stick around to the end where I'm going to show you what that really entails and what that means for the housing market more specifically. So let's dive right into this first story. All right, so this first story is coming in from Zero Hedge, and it's really just going over the key data that's going to be released this week. Markets pricing have slowly really been pricing in a 75 basis point rate hike, but have also considered the 100-point hike. The new summary of economic projections should also show unemployment ticking up higher, which I've been saying would be a concern in the moving forward and into the future. We'll also find out this week how steep a hiking cycle will be, how deep any recession, and how quick the recovery policymakers are expecting. Yesterday, we had the National Association of House Builders Housing Market Index was released. We'll be covering that in today's episode. Today, we actually had the housing starts and building permits, which we will be going over. Tomorrow, we'll find out what the existing home sales have been, which that should be interesting, as well as the Fed's decision on the basis points, General Mills and Lennar earnings, which are pretty good indicators of what's going on in the economy and the housing market as a whole. Thursday, we'll have Kansas City Fed manufacturing activity, as well as the initial jobless claims. And then finally, Friday, we'll hear from Fed Powell on his take on what's going on with the economy and their fight against inflation. Next story is Zillow. This has been a common theme, but Zillow has also revised their forecast again quite a bit downward. The forecast of 1.2% home valuation growth through August 2023. The latest forecast is decreased 16.4% from 2021. So Zillow expects the home value growth to slow considerably over the next year. Current rate of 14.1%, and that has been, as I just said, revised down to 1.4%. Moving on to the what's going on with the home builders. Prop up sales, 24% of home builders cut prices. Over 50% of builders reported using incentives to prop up sales or reduce cancellations. Among those would be mortgage rate buydowns, which I've mentioned, free amenities, as well as price reductions, which is really a last resort. Price reductions, the percentage of home builders who reported cutting prices jumped to 24%. So almost a quarter of home builders are now cutting prices. That's up from 19% in August and 13% in July. So from July to September, it's jumped almost 11%. With today's index value of 46, anything below 50 is considered negative. Now that the index is below 50 at 46, it's below where it had been in May of 2006, which we all remember what happened around that time. So this chart just indicates going all the way back through the financial crisis, 2005, what the housing market index has been. As you can see, it obviously dipped down when we had all of our close downs in 2020. And now we're heading back down that way, and rather quickly, almost as steep as when we had the shutdowns. When you break it down by region, these are the 4 different regions: Northeast, Midwest, South, and West. The green, which is the South, is the only one that actually remains in positive territory, and just barely. So that's just showing that sentiment has really declined across the board, even in the South, which is where we would be considered Florida market. Moving on to the residential construction, building permits, housing starts, and completions. If you take a look at the chart right here on the right, the blue is the permits. That is down quite considerably from previous month. Starts, which is a dark blue in the middle, that is up, and then completions is down. So when we break this down, building permits for privately owned housing units, 10% below the revised levels in July, 14% below August of 2021. Single-family authorizations were also 3.5% below the revised July figures. Privately owned housing starts in August were 12.2% above the revised July values. So that's good news. Same thing when you look at the single family housing starts in August, they were up 3.4% above the revised July figures as well. Moving on to housing completions in August for privately owned, they were down 5.4% below July. And then single family housing completions in August were actually up a little bit, 0.4% above the July rate. Redfin's latest market update has sellers losing the upper hand quite quickly, actually. When we take a look at this chart covering the last 3 years from 2020 on, as you can see in the winter months coming from the start of the year on, we see that the inventory is usually at its highest levels and slowly dips throughout the rest of the year, especially into the spring. And then in 2020, we saw that in the summer months, it did decline steeply. 2021, we did see it rise a little bit, but it really stayed pretty consistent and even, and then declined again into the winter months. But now when we look at 2022, you can see almost the reverse is happening. Going into spring, we had our lowest levels of inventory, and now into the summer months, and now into the beginning of fall, we're seeing the inventory continue to increase. A lot of that is because of the mortgage rates increasing so much and buyer demand decreasing. So inventory is starting to build up. Another new story that just came out, the home flipper Open Door, similar to the iBuyer program of Zillow that we talked about months ago. Open Door finally hit losses, which echoed obviously Zillow's collapse. The company lost money on 42% of its August resales after it obviously failed to anticipate what's going on in the market right now. So even worse in key markets like Los Angeles, where the company lost money on 55% of its sales, and Phoenix, where it lost 76%. So those were two of the hottest markets when we had the shutdowns over about a year and a half ago. And now they are some of the coldest markets as far as cooling quickly. The losses, which also don't include fees charged to the customers or the expenses incurred in renovating and marketing homes, which it can be anywhere from 6 to, 10, 15%, depending on how bad the home's shape is. Open Door warned its investors that it expected to lose as much as $175 million in adjusted earnings before interest, taxes, depreciation, and amortization in the third quarter. One of the commentaries on it, Del Priest said he doesn't know why the company would try to accelerate sales when they're losing money on those sales. That's something that Open Door has been recently doing, is trying to sell more homes that they have purchased. First hypothesis is that they want to book as much revenue as possible in the third quarter for their markets and for their stock. But the second would be that they think things are going to get far worse and want to lose a little bit of money now versus a lot of money later on. I think the second hypothesis is probably the more accurate one, but we'll have to see as we go forward. ARMs are on the rise, another concern that really did happen in the housing bubble of 2008. So that share of mortgage borrowers taking out ARMs has been on the rise. Zillow shows that 12.6% of mortgage applications were for ARMs in June and 12.2% in July. I think that's going to be higher in August and September. Tropical Financial Credit Union in Miramar has seen a 25 to 30% uptick. Centennial Bank in the Southeast Division has seen a 10 to 20% uptick. If you're not familiar with adjustable rate mortgages or the types that are out there, there's a lot of different kinds out there. But what happens is there's a set interest rate for a period of time. It's usually lower because it's adjustable later on. So they know that they can make more money later on. Usually for a set period of time, anywhere from 1, 3, 5, 7, 10 years for the initial period. And then after that, it resorts to an index, and the rate will adjust based on that index, whatever index they decided to use. And those adjustments can happen every year or even every 6 months. So it can be an extremely volatile loan, especially if the future interest rates look like they're going to be a lot higher. It's really not an advantageous loan. It's usually only advantageous in the short term. And that obviously echoes concerns with the 2008 crash. Lenders have been more stringent with their loan terms and who they loan their money to, and even for these ARMs. However, the bigger concern that I would be more worried about is the layoffs that would probably be coming in the future versus being able to afford the interest rates later on. I think the short term is more of a concern right now than the longer term. Straight from Bloomberg, more Americans are stuck with long-term credit card debt. 60% of credit card debtors owe card debt for a year or more. 1 in 4 respondents carry a balance to cover daily costs. 60% of credit card debtors say they have been in credit card debt for at least a year. That's up 50% from a year ago. The share of those who have been in debt for over 2 years has also increased from 32% 32% up to 40% now. And a majority of this is coming from consumers in their 20s and 30s or lowest income brackets, who are likely to cover these to carry these debts for longer periods of time due to daily expenses like groceries, childcare, or utilities than the older generations. About a quarter of respondents said day-to-day expenses are the primary reason why they carry a balance. So I'm pretty sure that that's something that's more recent, at least the statistics being that high, more so due to the recent inflation and everything having risen over the last year. One of the other stories that I mentioned yesterday was that the Chinese-U.S. tensions, and it's pretty confusing when you really actually read the article and listen to some of the stuff that's been said. But what the U.S. in a 60 Minutes interview, Biden was asked what the U.S. reaction would be if China decided to invade Taiwan. He answered yes, if there was in fact an unprecedented attack, they would defend Taiwan. However, this is where it starts to get a little confusing. He was also quick to reiterate that the U.S. maintains a one China policy and doesn't currently support Taiwan's political independence. So I really don't understand how that works, how you support independence but not their independence from China. So that's just one of the things that's going on right now that I think has started to get a little bit more tense over the last few weeks. But then I also wanted to cover this last story, and it's really more, it's not so much, what the hedge funds are doing, but it's really more to explain what's going to be happening with the Fed and why I think things are just really getting started with the housing market. So the world's largest hedge fund makes the ultimate case for gold. This is not pushing gold. I just thought that some of these parts in the article really do a good job of explaining what the Fed is looking to do. Rebecca Patterson, Chief Investment Strategist at Bridgewater Associates. If you're familiar with Ray Dalio, that's who owns or began Bridgewater Associates. The world's largest and most successful hedge fund, explained how the firm is bracing for a prolonged stagflationary period. Patterson doesn't necessarily believe the Federal Reserve will make a policy U-turn. An awful lot of Wall Street observers may be expecting it, but she said that a policy reversal will be far more damaging to the economy than the effects of ongoing tightening. With that being said, I've been saying that the Federal Reserve will make a U-turn, but I did not say when. It's really going to be indicative of what happens with the 2 and 10-year bonds. If you remember back to those the charts where I overlaid it with the federal funds rate and the 2-year bond, when the 2-year bond spikes and the Federal Reserve chases it with their Fed funds rate, the time that the Federal Reserve will, in fact, or is most likely going to reverse course is when the 2-year bond yields start to subside and then the federal funds starts to catch up. When those two lines cross, that's when usually a month or two or maybe even 3 months after that, that's when the Federal Reserve will start to ease monetary policies again. This is a problem for the Fed, though, right now, because the market is still thinking that they're going to have a U-turn. So with that being the case, in order to actually begin to cool the economy, they must raise interest rates sufficiently to deflate the bubbles in stocks and housing. When investors double down by pushing those inflated asset prices higher, betting on an imminent U-turn by the Fed, it forces the Fed's hand. Speculation must be countered by monetary tightening. When the Wall Street fights the Fed, we all lose. So the more people keep putting money in and betting on the fact that the Fed is going to reverse course, that's pushing the assets higher, it's pushing stocks, it's pushing housing higher. And when that happens, the Fed has to tighten even more. So the more Wall Street and investors continue to fight the Fed, the more the Fed is going to cause harm to the economy is essentially the gist of it. Well, that's it for this week's headline highlights. I hope you got value out of today's video. And if you did, please hit that thumbs up button to let me and YouTube know to get this information out to more people. And consider subscribing if you haven't done so already and hitting that notifications bell so you can stay up on the latest data, tips, and news, keeping you ahead of the market trends. And if you have any questions or would like to work with me directly, feel free to use the link in the description to download my digital contact card. It has all my information to reach out to me directly at any point in time. Otherwise, as always, stay safe, stay positive, and more importantly, stay free.